Hello and welcome to today's session on investment banks. I am Dr. Raghavi, and today we will explore the structure, functions, and types of investment banks. Investment banks play a critical role in financial markets, supporting corporations, governments, and high net worth individuals with complex financial needs. Through this session, you will gain a deeper understanding of how investment banks operate, their core services, and their impact on the global financial landscape. What are investment banks? Investment banks are specialized financial institutions that provide advisory and investment services to large corporations, governments, and institutional investors. Unlike retail banks, they do not offer services to general public. Instead, their expertise lies in managing high value transactions such as issuing securities, trading in financial markets, portfolio management, and advising on mergers and acquisitions. Investment banks are essential for clients with complex financial needs, offering services beyond what typical commercial banks provide. How are investment banks different from commercial banks? Investment banks and commercial banks serve different purposes. Investment banks focus on raising capital, asset management, and providing advisory services for major financial transactions. They do not accept deposits or provide retail loans. Commercial banks, on the other hand, focus on accepting deposits, lending to individuals and businesses, and offering savings account. While commercial banks mobilize savings, investment banks act as intermediaries, facilitating investments and helping companies access capital directly from the markets. Let us see the history and evolution of investment banking. The concept of investment banking dates to merchant banks in UK, which financed trade and commerce. In the US, the Glass-Steagall Act of 1933 separated commercial bank and investment banking until it until its repeal in 1999, which led to creation of something called as a universal bank, just like Citigroup. In India, investment bank evolved from merchant banking in 1970s to a more structured industry in the late 1990s, driven by the entry of foreign investment banks. The major investment banks include something called as bulge bracket. The largest investment banks are often referred to as bulge bracket firms. Historically, these includes names like Lehman Brothers, Goldman Sachs, and Merrill Lynch. Today, leading names like Goldman Sachs and JP Morgan Chase continue to operate globally, specializing in large scale corporate finance, securities underwriting, and advisory services. These banks are known for handling high net worth complex transactions worldwide. The functions of investment bank include various things. Investment banks provide several core services. They assist companies in issuing securities, especially through initial public offers, also known as IPOs, enabling companies to raise capital. Underwriting is another essential function where investment banks guarantee the sale of securities, thus offering security to the issuing firms. Additionally, investment banks provide M&A advisory services or merger and acquisition advisory services, helping companies with merger, acquisition, and restructuring. They also offer asset management services for institutional and high net worth clients, providing advisory on a range of investments. The following are the types of investment banks. Investment banks are categorized into three main types: full service global investment banks, regional investment banks, and boutique investment banks. Full service banks operate globally, serving large corporations, while regional banks focus on specific geographic markets. Boutique banks, on the other hand, are smaller and specialize in niche advisory services such as merger and acquisition or private equity for a specific industry. Let us see them one by one. Full service global investment banks operate on a worldwide scale, offering comprehensive services to multinational corporations. Examples include Goldman Sachs, JP Morgan Chase, and Kotak Investment Banking. These banks handle large complex deals, offering everything from securities issuance and trading to merger and acquisition advisory and asset management. Their global reach and vast resources allow them to serve major corporations across the industry. Then we have regional investment banks. Regional investment banks, as the name suggests, focus on specific geographic markets. They are highly knowledgeable about local economy and cater to middle market. Examples include Piper Jaffray, which serves the US middle market, and Simpsons and Company, which serves and specializes in energy sector in Europe. These banks play an important role in their regions, providing specialized services tailored to local industries and business. Further, there are boutique investment banks. Boutique investment banks are independent firms that provide specialized advisory services. They often focus on specific areas like mergers and acquisitions, private equity, or venture capital. These banks cater to high net worth individuals and smaller companies offering personalized services. Avendus Capital and Veda in India are examples of boutique banks specializing in merger and acquisition and private equity, particularly for the Indian market. The role of investment banks in securities issuance is one of the primary roles that the investment banks do. They help companies to prepare for IPOs, set an appropriate price for the shares, manage regulatory compliances, and ensure demand by underwriting. By underwriting, investment banks guarantee the sale of shares, thus facilitating capital raising for companies looking to expand or improve their financial structure. In M&A, investment banks provide advisory on deal structure, conduct valuations, and negotiate terms on behalf of their client. They work on both the buy side and the sell side, assisting companies in either acquiring assets or selling parts of their business. This includes restructuring, spin offs, divestitures, where investment banks help clients navigate complex transactions for specific growth or consolidation. Investment banks also provide asset management services managing the portfolio of high net worth individuals and institutions. These portfolios can include stocks, bonds, real estate, and other investments. Investment banks leverage their expertise to build diverse portfolios that align with clients' risk tolerance and financial goals, offering a pathway for wealth preservation and growth. The regulatory environment for investment banks is important to understand because this helps us to know how transparency is ensured in the financial markets. Investment banks are regulated in India by SEBI. SEBI governs their activities under merchant banking regulations. In US, investment banks must adhere to SEC's regulations which cover reporting, anti-money laundering and global and customer protection. Global regulations such as Basel III and Dodd-Frank Act focus on risk management and liquidity requirement, promoting stability within the sector. Investment banks have profoundly impacted global markets, particularly during significant periods like 1990s tech boom and 2008's financial crisis. Deregulation in the 1990s allowed for the creation of universal banks, merging commercial and investment banking. Today, investment banks continue to play a key role in capital formation and corporate growth and financial innovation. Working with investment banks offers several advantages. They provide efficient capital raising solutions, handle complex transactions with expertise, and offer access to global markets and network of investors. These advantages make investment banks essential partners for companies looking to grow and expand on a large scale. There are certain challenges which investment banks face. Despite their importance, investment banks have their fair of challenges. Regulatory compliances can be costly, and they must constantly adapt to changing regulations. Market volatility impacts deal making and investment, and competition from fintech innovations present a challenge to traditional banking models. Addressing these channels require agility and innovation. In conclusion, investment banks are crucial intermediaries in the financial markets, helping corporations raise capital, manage assets, and expand through M&A activities. Their services drive economic growth, support business expansion. Despite challenges, investment banks continue to adapt, making them a cornerstone for the global financial system. Thank you, and we will meet again.